Hello students, welcome to today's session on rules of debit and credit. Okay, so in this I'll gonna cover in three portions. Okay, meaning of debit and credit, traditional classification, modern classification, and finally some practical examples. So to begin with, okay, the introduction or meaning of debit and credit. What is how anyone can understand what is debit and credit? All right. So the debit and credit are accounting items used to record the dual effects of every financial transactions. Debit entry appears on the left side and credit entry are on the right side of the ledger. Okay. So accounting entries, in the having the dual effect. So dual effect means every financial transaction must be having either debit or credit. Debit entry appears in the left side while credit entries on the right side, especially in the T account. Okay. Debits typically increases assets and expenses and decreases liability and incomes. Credits have the opposite effects. That means once the assets are decreasing, it should be in the credit. Okay. And once the liabilities and incomes are increasing, it is in the debit side. All right, moving to the next, that is the traditional classification. So traditional classification, it is also known as golden rules of accounting. So golden rules of accounting, it covers or it classify entire transactions in three segments. One is real account is the account in which we can see something, coming, going, right? Personal account, it is the individual's account, right? Like Ram's account, firm's account, bank account, something like that. And nominal account is like, rent, commission, okay? So for real account, rules for debit is debit what comes in and credit what goes out, okay? So here I can give an example. So machinery purchased, okay, on cash 2000. That means cash goes out. So what goes out as per the real account rule, it is in the credit side, and machinery purchase, that means it comes in the business, so it should be in the debit side. So similarly for personal account, okay, Ram's account, I mean if any cash given to Ram, so debit the receiver, that means Ram would be the receiver side. So Ram's account will be debited and cash account will be credited to the giver, right? So this is the personal account. Now nominal account, it is the account, okay, in which expense, losses, these are covers, okay. So rent it is an expense, okay. So debit all expenses. So rent paid, okay. So if rent paid in cash, maybe we can consider as debit all expenses. So rent would be debited and cash goes out, okay. So it should be credited. So for entire, transactions, what happened in day out, for that entries in general, we have to classify real account, personal account, and nominal account. On that basis, the debit and credit will be posted. Okay. Moving to the next one, that is the modern classification. So modern classification, okay, it is some sort of classification in which we have classify asset, liability, capital, expense, and income. So it has the similar, debit and entries, but based upon the effect. So if asset side increases, that means increase in assets, it should be always debit effect. Okay. Decrease in assets, it is credit effects. All right. Similarly, liability, decrease in liability, okay, it has debit effects. Increase in liability, credit effect. Capital or owner's equity, if it is increased, it should credit side. If it is decrease, debit effect. Expense and losses. Okay, so if there is increase in expense and losses, it should has, I mean, it is having debit effect, and decrease, it is credit. All right. So if you are talking about this expense is concern, okay, so any increase or decrease, it has their debit and credit effect. So if it is expense increases, debit effect. If it expense decreases, it has credit effect. Same in for income and gain. So if there is any decrease in income and gain, it has debit effect, and any increase, it is having the credit effect. So this is known as the modern classification. All right. Now moving to the next one, some practical examples. Okay. So purchase furniture for cash. So purchase furniture for cash, debit furniture account, because debit is furniture is a real account and it comes in. So what comes in? It is debit size, and cash goes out. That means credit side. Okay, so cash credit and furniture account debit. Second one is rent paid. So rent paid, it is nothing but the expense or losses. Okay, so rent paid, expense, so it is debit side, and credit side, I mean, cash goes out, so it's a real account, so what goes out, it is credited, so it is in the credit side. Similarly, received commission, it is nominal account. So rule for the nominal account is, okay, all income and gains are credited. So commission income, it is a kind of gain, so it is credited. And cash, okay, debit cash, asset comes in, cash comes in, okay, so it is debit side, so it is debited. So these rules ensure that every transactions keep accounts balanced. That means in the double entry system, both debit and credit side should be matched, okay, and it is very much required in the bookkeeping. So for each and every transaction, there are two effects. One is debit side, another is credit side. So both accounts or both sides of the leg of the transaction should be matched. All right. So I mean, just to summarize it, so the golden rules are very much important. Okay, and it is very helpful, I would say, or it is the rule which is applicable for all the transactions to classify first real, nominal, and personal account, and based upon that have to apply the rule whether which account will be debited or credited. Okay, so that's it for all today's session. I hope you all understand the topic. Keep practicing, and I'll see you in the next time. If you have any doubt, please contact me through my Urban Pro profile. Thank you.